Chapter 9 brings responsibility accounting and investment center analysis. We're going to discuss some calculations that we need to know for this chapter, and we're going to look at how we use them as well. First thing that we're going to talk about is allocating indirect costs. In this chapter, we identified how we separate direct and indirect fixed expenses of the corporation. Sometimes they will be allocated to segments, sometimes they will not. When they are allocated to the segments, they can be done any way the company wants, very similar to activity-based costing or predetermined overhead rates that we did several chapters ago. So the concepts are still the same. We're going to do one example like this first, just talking about how we allocate those indirect costs. So let's take a look at exercise D. And we have three segments, segment A, B, and C of Trump Enterprises. We have sales of $300,000, $150,000, and $50,000. And there's a pool of $25,000 administrative overhead expenses that are going to be allocated on the basis of net sales. So first thing we need to know is how much of that $25,000 should be allocated to each segment. We need to know what our basis is. Our basis is net sales. So we need to know the net sales of each segment. Segment A had $300,000, segment B had $150,000, and segment C had $50,000. We add those together to get a total of $500,000. Next, we can calculate the percent of net sales. This is just an extra step that we do. We don't have to do this, but we can. And this is going to be the $300,000, which is the segment A sales, and we're going to divide it by the total of $500,000. We can leave it as that fraction if we want, or we can use it as a percent of net sales. Either way is going to give us the same result. So this means it's 60% of sales. So we're trying to allocate $25,000 in cost. So we're going to take the $25,000 in cost and we're going to multiply that by 60%, which is my percent of net sales. Or we could do the $25,000 and multiply that by our $300,000. Divided by our $500,000. Either way would work just fine for us. And we're going to get $15,000 in cost allocated. So now we're going to repeat the process for segment B. Segment B, we're going to have the $150,000 divided by $500,000. Which means we have 30% of net sales. And for segment C, we have 10%. We're still trying to allocate the total of $25,000. So we're going to take 30% of that is going to go to segment B. And 10% is going to segment C. We can prove this because the total of these comes to $25,000, which is the amount of administrative overhead we want to allocate. So we know that we allocated the amount correctly. So this is what would happen when all three segments are involved. Now, if segment C is eliminated, this cost of $25,000 isn't going to change. So we're still going to have $25,000 of admin expenses. It's just going to be allocated between segments A and B only. So we would repeat the process for that. Segment A had $300,000, Segment B had $150,000, so now we're looking at $450,000 in total sales. So my calculations would be the same as before, except instead of dividing by 450 or 500, we're dividing by 450,000. So we have 67% and 33%. We want to take the 25,000 and we're going to multiply it by the 300 divided by 450. And we're going to take the 25,000 times the 150 divided by 450. And guess what my total is? Still $25,000. So we allocated it differently, but we still have that $25,000 to work with. All right, that is allocating indirect costs. Now we're going to move on to investment center analysis. We're going to use problem H for this, and we're going to use for company. So for company, we can see that the company as a whole has this information, which is sales, income, and the investment base. One of the segments is the sports segment. Within the sports segment, there's a woods project, an irons project, and then this is the total for the sports segment. We're anticipating that these relationships will stay the same, which means sales will stay the same, costs will stay the same, income and investment should stay the same. We're not expecting any changes. But we are looking at adding a new project, and the putter project will have this information. First thing they want us to do is determine the return on investment for each of the segments and the products that we're working on. So let's work on that. Okay, so for company. For company is this information. We calculate return on investment as the segment income divided by the investment base. So they give us the segment income, or the company income in this case, is $1,125,000. The investment base is $4.5 million. So if we divide, the amount comes to 25%. Return on investment is typically shown as a percent. We want to carry it at least to one decimal place after we've turned it into a percent, so it'd be 25.0%. That means for every dollar of the investment, it's bringing in 25 cents of income. So for every dollar of the investment, it brings in 25 cents of income. Now let's look at the sports segment total. So we want the sports segment, and we want to look at the totals. The total sales, or the total income for the sports segment, is $337,500. It has an investment base of $1,005,000. We divide, and we get a return on investment of 33.6. So that means it's close to 34 cents on every dollar. So every dollar of our asset brings in 34 cents of income. Let's look at each project individually. For the woods project, we want to look at our income divided by the investment base. Income is $300,000. The investment base is $900,000. So that gives us 33.3%. The irons project is an income of $37,500, and we have an investment of $105,000. So the irons project is a little bit stronger than the woods project, but it is smaller in scope, which is why it impacts this sports segment just a little bit. The next thing it says, what would be the effect of adding the putter project on the sports segment's return on investment? So we want to look at the sports segment with the putter, and we want to look at the putter project separately. We're going to compare the information that we have here, as this is the sports segment without the putter. So right now we're at 33.6% as a return on investment. So our segment income, let's look at the putter project first. The putter project has income of $52,500 and the investment is $187,500. So that's going to give me a return on investment of 28%. Now, this immediately tells us that there could be a problem because it is lower than both the Woods and the Irons project, but it's not that large. So what would be the impact on the total sports segment? We know it's going to go down, but how much is it going to go down? So my segment income with the putter project, we're going to take the income before the putter project, and then we're going to add the income the putter project will bring in. For the investment base, we're going to take our sports segment investments and we're going to add the putter investments to it. If we divide, we'll see our return on investment is now 32.7%. So this does decrease my return on investment, but this is still a really good return on investment. We're still making 33 cents, 32.7 cents for every dollar, which is a nice thing to do. Last thing we need to do is we need to calculate the residual income. We're going to calculate the residual income for the wood, iron, and putter project. We're going to look at the sports segment without the putter and the sports segment with the putter. So we need to know our segment income. The Woods project was $300,000. We get that from over here, $300,000. Irons project was $37,500, and the putter project was $52,500. To calculate residual income, we take the segment income minus a minimum income. The minimum income is calculated as the investment times a cost of capital. And it says the cost of capital is 25%. So we know our cost of capital is 25%. So now we need to know our investment base, which we get here. The Woods project is $900,000. The Irons project is $105,000, and the putter project was $187,500. Make that red so that we know it's not involved in the real calculations. Okay. So we're going to take the 900 times 25,000, and that's how we get our minimum income. To calculate the segment income, or the residual income, we take the segment income minus the minimum, and we have $75,000 left, which is good. The Irons project gives us $11,000, and the putter project is bringing in $5,625. So we know right off the bat that the difference is going to be $5,625. So that's going to be the difference in my sports segment. We're going to have an increase in residual income by $5,625. We can prove that further by looking at the sports segment without the putter. So that's going to be my income here of $337,500. I'm going to have an investment base of $1,005,000. And that gives me minimum income of $251,250. So if I take the segment income minus minimum income, we get the $86,250 without the putter. With the putter, my segment income is $390,000. My investment base increases to $1,192,000, giving me a minimum income of $298,125. Residual income we calculate as sports segment income minus minimum, and we get the $91,875. The difference being, no surprise, the putter project of $5,625. So think about it. Should we do it? What's the risks in doing this putter project? What should we be looking for? We do increase our residual income, even though our return on investment lowers just slightly, so we could argue either way. Whatever you do, make sure you support your answers. Good luck.